Hello everyone, I'm Sahil and welcome back to the channel. In this video, I wanted to discuss this article that was shared by Bruce on my Discord channel. So thank you very much Bruce for bringing us this amazing information and for the viewers as well. So yeah, and if you're someone who wants to join the Discord channel, I will be linked down in the description below. Feel free to come on, it's completely fine. But the only thing I require from you guys is to just come in and introduce yourself before I add you into the rest of the main channels, okay? So that being said, let's hit it out. Alright guys, so this article was published on 30th of July, which is quite recent, right? And the author over here is trying to cover the entire insurance sector of China as a whole. So the title is "The Insurance Sector Has Fallen 37% During This Year," which is quite obvious, right? I started covering Ping An when it was trading at 100 HKD back in Feb, and now it has fallen down to 68 Hong Kong dollars, which is a steep decline, right? And it's been a pretty bad year for insurance sector as a whole in China basically. And the author of this article is trying to share his own findings on what's happening behind the scene and also trying to establish what's the reason behind it. One thing to take note about this article is that it's originally published in Chinese and it's been Google translated, so the English is a bit off. Just bear with it. And getting right into it, I've highlighted the key points in yellow, so I'll be covering it with you guys. First of all, the author establishes that at the end of second quarter, right, which is end of June, the value of public equity fund holdings in insurance stocks had dropped to 33.3 billion yuan, which is a record low since 2017. And at the same time, he also established the position of public fund in insurance stocks were mainly concentrated in Ping An of China, accounting for 82% of their allocation within the insurance sector. So what I get out of these two key points, right? Firstly, like obviously there's a downward pressure and there's some pessimistic view on these public equity fund holdings shrinking their position into the insurance sector as a whole. It's nothing about the companies, but as a whole, they are shrinking their position into the insurance sector. So yeah, and also I think it might be a very big reason why A share is trading at a huge discount from head shares. There's a 5% discount on A shares if you guys don't know. So if you want to buy, you can buy from A shares. And basically all this Chinese public equity fund, right, they are invested through A shares. So if they're selling their position, then that will definitely put a huge downward pressure on the A share instead of head shares. And I think it's pretty consistent like in the past few weeks, because that's the time where we started to see this discount on the A share. So yeah, that is the first thing. And secondly, even though they are reducing the allocation, they are heavily invested into Ping An of China. And what that tells me is that the fund managers themselves are huge bull on Ping An of China. I mean, not bull, but they view Ping An of China as the most superior insurance company of China at the moment. They have 82% weightage on them. So that really says something on their views on Ping An of China. And I completely agree with them on where Ping An of China stands today and where they would stand in the future as well. And I think I've discussed that a lot in the past few videos. Also, you can compare all the new insurance companies that have been popping up. They are also led by technology, just like how Ping An of China is also trying to drive. But the key differences here is that those insurance companies are serving very small clients, where Ping An of China is serving huge corporate clients as well as the wealthy, affluent people. Whereas these smaller tech insurance companies are only serving the public of very, very small underwriting. So yeah. And at the second point, being such a huge company, they have a lot of synergy, and I've shared it on multiple times on what they are doing into individual industries, not just in insurance, just to have that synergy and to uplift their service as a whole. So yeah, you can go and see my other videos into it. Moving on, this article also covers on the reasons why this is happening, why is the allocation shrinking, and they suggest that the main reason is due to a double pessimistic expectation on the liability side and investment side of the insurance industry. So starting with the investment side, right, I believe that is the first thing is starting in March, when the insurance sectors actually started to decline in the stock price, there was one company that went bankrupt. They defaulted on their bonds. So that particular company was from the real estate development sector, And what's happening is like there's a new policy in China that reduces the amount of leverage and debt that these real estate companies can take. So that has resulted into like these companies who rely on refinancing their debt, they are unable to refinance, and that has led them to their bankruptcy. And the government is trying to do so because everybody knows that this industry in China is overly leveraged and it's in a bubble stage right now, a huge bubble. So they don't want it to pop, and they are slowly letting the air out of this bubble. And yeah, so these are the victims of this company. In March was the first company that was victim of this deleveraging into the real estate industry, and that has also trickled down into more companies. Like we have heard about this Evergrande that is facing something on a similar ground as well. So yeah, the public or the public funds themselves, the manager, are pessimistic on a view that if there are more bankruptcies down the line, there are huge impairments to be taken by these insurance companies who have invested into these state owned companies, both in terms of debt and also equity. So that's one thing. And also due to the pandemic, the central banks around the world has decreased their interest rates, and these companies, right, insurance companies, they are heavily invested, particularly for Ping An of China, right. More than 50% of their investment of their asset holdings are into treasury bonds. So that if there's a decline in the interest rate, that you can also expect that the interest that they earn on their investment into these treasury bonds will also decrease, and that again is a pessimistic view. All right, in terms of liability, obviously there are these bankruptcies or whatever has been happening due to the pandemic itself. There are claims related to the pandemic, deaths and everything. And at the same time, recently there was a flooding in Henan, which has also resulted in a lot of payouts and liabilities. So getting into the main things, right, the insurance itself. So the article says that in terms of personal insurance, there was a good start, which was superimposed by the old and new definition of critical illness. So there was an increase in the premium because of a new definition of critical illness. So yeah, at the beginning of the year, but the follow-up support was insufficient and the premium growth was under pressure. In terms of the property insurance, the pressure of comprehensive reforms of auto insurance continued, and the auto insurance premiums were under pressure as well. This I've also covered, and this is exactly the 2 points that Ping An Insurance also mentioned in their Q1 earnings, and they put the blame on them for the declining income from insurance premium. On the investment side, long-term interest rate, like I mentioned, is also fluctuating downwards, and superimposed equity market increased volatility, which has also lowered the insurance index. I'm not sure what this means over here, but volatility and all those things, the stock market is going down. I'm not sure. So just take it for the word. If you guys understand that what he's trying to say, just put that in the comments below. All right. That being said, let's go ahead and yeah. And here is the point of the natural disaster, right? So since the second half of the year, the occurrence of natural disasters such as heavy rain and typhoons in Henan has brought great pressure on the operating performance of the insurance industry. As of July 26, which is like I think 3 days after the flooding happened, I think it happened in July 23rd, right? There were already 360 reports, and the estimated loss just by these reports were 9.2 billion yuan. So this is obviously expected to increase. And Ping An themselves also published announced that they are estimating that the total amount of compensations for Henan rainstorm cases will exceed 1 billion yuan. But I think that is not a very bad number. I was expecting more because Ping An themselves, right, their net earnings for last year was at 144 billion yuan. So 1 billion or 2 billion yuan won't make a dent into their net earnings. So that is not a big thing over here. Yeah, so that is the main points of this article. You can also come and join the Discord, and you'll find this article over here, the link to this article. And obviously, yeah, just join in to just have a look at the whole article. And also this particular resource itself is pretty extensive, and they cover the insurance industry pretty well of China. So if anybody is interested, please come and join and get into it. Bring your wealth of information as well. I think It's pretty great. I wouldn't have come across this if it wasn't Bruce who has brought up this article. And there are also other members of the community that has been contributing a lot, and I thank you all, Ian, and there's Raju as well. So yeah, thank you guys for putting in and bringing in so much information for me to also digest. Yeah, thank you very much. With this, I will end this episode. Bye.